As of July 23, 2026, during active intraday trading, SoFi Technologies Inc., listed on NASDAQ under ticker symbol SOFI, is trading at $16.57 per share, reflecting a decline of 50 cents, or approximately 2.93% for the session, on strong trading volume exceeding 19 million shares. While short-term market participants looking at daily momentum indicators might view this pullback as a signal to step aside, a deeper look reveals a classic divergence between expectation and reality. The prevailing expectation across financial media is that SoFi remains a high-beta consumer lender heavily vulnerable to elevated interest rates, fluctuating macroeconomic conditions, and regulatory headwinds surrounding consumer debt. The reality, however, is that SoFi has systematically restructured its core business model to insulate itself from single-product vulnerabilities, transforming from a simple student loan refinancing platform into a fully-fledged national digital bank with an expanding deposit franchise. When evaluating recent stock price action, SoFi has traded within a defined range between $16.50 and $18.75 over the past several trading weeks, attracting intense attention from both institutional funds and retail communities. In recent sessions, institutional trading desks have consistently stepped in during dips near technical support, indicating quiet accumulation while broad market volatility plays out. While mega-cap technology leaders like Tesla stock, Apple stock, and Nvidia stock dominate daily financial headlines, Fintech equities like SoFi offer a distinctly different profile tied to consumer financial health and digital banking adoption. Traders active on major platforms including Robinhood stock trading, the Robinhood app, and interactive brokers platform setups have been closely observing trading volume spikes leading into the company's upcoming second quarter earnings report. This heightened retail engagement highlights a growing preference among individuals who focus on self-investing, use online investing tools, and maintain an individual brokerage account to capture growth opportunities outside traditional financial channels. To understand why Wall Street frequently misprices this business, one must examine the broader competitive environment. A common assumption among traditional market analysts is that legacy brokerage giants and established investment firms possess an unassailable advantage over digital-first entrants. Investors constantly weigh whether to seek investment help from established institutions, utilize Schwab Intelligent Portfolios, or rely on Fidelity Wealth Management for long-term planning. Traditional firms offering Fidelity ETFs, Fidelity mutual funds, Fidelity IRAs, and comprehensive tools through the Fidelity mobile app or Fidelity trading platform have spent decades building brand trust. Similarly, popular consumer platforms offering Robinhood Investments, Robinhood Crypto, Robinhood Cash Management, and Robinhood Fractional Shares compete fiercely for young investors starting their wealth creation path. But the expectation that SoFi cannot effectively compete with these incumbents ignores its primary structural advantage, its national bank charter. Unlike pure-play digital brokerages or third-party non-bank lenders, SoFi's bank charter allows it to gather direct deposits directly from its members. When consumers set up direct deposit to receive their paychecks into SoFi checking and savings accounts, the firm gains access to low-cost, sticky capital. Instead of paying high market rates to borrow wholesale funds to originate loans, SoFi funds its loan operations using its own deposit base, significantly lowering its cost of capital and boosting net interest margins. In recent quarterly earnings reports, SoFi demonstrated the power of this funding model, generating over $1.1 billion in quarterly adjusted net revenue and delivering sustained positive net income. This operational transition from burning capital to generating hundreds of millions of dollars in net income marks a clear shift in performance, yet the market continues to price SoFi stocks at valuation multiples that reflect historical fintech skepticism rather than banking durability. Looking closely at the underlying business structure, SoFi operates across three distinct operating segments: lending, financial services, and technology platform. The lending segment, which originally centered around student loan refinancing, now encompasses a well-balanced mix of personal loans, student debt consolidation, and home mortgages. The financial services segment houses checking, savings, credit cards, and SoFi Invest, providing tools for members who want to invest online, manage an intelligent portfolio, or explore SoFi ETFs and SoFi active investing options. Meanwhile, the technology platform segment, driven by Galileo and Technisys, operates as an infrastructure provider for other global financial institutions, enabling payment processing, card issuing, and digital core banking solutions. This means SoFi is not merely a front-end consumer application. It owns the core infrastructure that powers digital transactions across the broader industry. This integrated technology architecture powers an effective cross-selling flywheel. When a member joins the platform for a high-yield checking account or a personal credit line, SoFi uses its unified digital interface to introduce them to additional products, including SoFi Robo-Advisor Management, SoFi Trading Platform features, and mortgage services. Because all products live within a single mobile environment, customer retention rates remain exceptional, while customer acquisition costs drop sharply over time. While investors who trade through Fidelity Brokerage or manage an Interactive Brokers account often use specialized platforms for specific tasks, SoFi consolidates personal financial management into a single digital ecosystem. This product density drives higher revenue per member over time, a metric that traditional banks struggle to match with legacy branch networks. Macroeconomic dynamics play a crucial role in shaping SoFi's near-term outlook. With the Federal Reserve carefully balancing interest rate policy, interest rate movements create contrasting effects across SoFi's business units. Should interest rates decline, loan origination volume across personal loans, mortgages, and student loan refinancing is expected to accelerate dramatically, spurring revenue growth in the lending division. On the flip side, if interest rates remain elevated longer than anticipated, SoFi continues to benefit from strong net interest income derived from its high-yield deposit base exceeding $20 billion. A major concern among pessimistic market commentators is that elevated borrowing costs will inevitably trigger higher loan defaults across consumer balance sheets. However, the reality of SoFi's credit portfolio challenges this thesis. The average SoFi personal loan borrower boasts a FICO score above 740 and an average annual income well into six figures. This prime borrower demographic has demonstrated remarkable resilience, keeping charge-off rates stable and well below industry averages, even in choppy economic environments. At this point, I want to hear your thoughts directly. Comment below how many shares of SoFi you currently hold in your portfolio, or let me know whether you prefer managing your assets through traditional brokerages like Fidelity and Charles Schwab, or newer digital platforms for your self-investing goals. Hearing your perspective provides valuable real-world context on how individual investors are navigating the current market environment. Looking ahead toward future growth drivers, SoFi continues to expand its reach into new high-margin verticals. The recent introduction of small business lending solutions alongside AI-driven personal finance assistants like SoFi Coach and Composer deepens engagement across its growing member base. Furthermore, SoFi's launch of bank-issued stablecoin initiatives highlights its willingness to embrace modern digital financial technology within a strictly compliant framework. While platforms like Interactive Brokers cater to active traders focused on Interactive Brokers fees, Interactive Brokers trading tools, and global market access, SoFi targets everyday consumers seeking simple, comprehensive solutions for managing their entire financial lives. Naturally, an objective analysis requires weighing key risk factors and potential downside catalysts. Bank regulatory capital requirements require SoFi to maintain strict capital ratios as its asset base expands. Rapid asset growth demands careful capital management, and if asset growth outpaces organic capital generation, management could eventually need to raise equity capital or temper loan growth rates, which could exert temporary downward pressure on the stock price. Additionally, competition across the digital wealth management space remains intense. Traditional platforms offering Fidelity investments and advanced features on the Fidelity mobile app, as well as competitive offerings in Robinhood Crypto and Robinhood Investments, means SoFi must continually invest in product innovation to preserve user retention and maintain top-line momentum. To bring our analysis together, the contrast between investor expectations and fundamental reality creates a compelling dynamic for long-term market observers. Wall Street often treats SoFi like a speculative tech stock, subjecting its valuation to dramatic swings based on broader macro headlines and sector-wide sentiment shifts. Yet a clear evaluation of its financial statements reveals a profitable, highly adaptable digital financial institution that is gaining market share from legacy banks and competing effectively across major